Very good evening, all of you. Please confirm if my audio, video, and screen is properly visible and clear. Good evening, guys. Hi, Siddhant. Hello, everyone. Good evening, everyone. How's your preparations going on, everyone? Good evening, Yogesh. Good evening, Arun. Good evening, Siddhant, Nutan. How are your preparations going on, guys? The exams are around the corner now. All good? Okay. So today our topic for discussion here, the revision, is we'll discuss revenue, ethics, impairment of non-current assets, and fair value measurements. Okay. Now, let's start with the topic 1, that is revenue. Okay. Understand, guys, the name of the standard. First, understand that this is governed by IFRS 15. This is governed by IFRS 15, and the name of the standard is revenue from contract with customers. Revenue from contract with customers. So understand the meaning of the name first. See, when we say revenue, we mean to we always understand the gross receipts, right? The receipt from receipts. But understand, just understanding it is a gross income or a gross receipts is not sufficient. We need to understand the gross receipt from what? See, understand the receipts can come from investment income. Is that revenue? No. Receipts can come from interest income. Is that revenue? No. So basically, receipts from sale of goods or services. Now, let's suppose I sell this tablet. Is that revenue? No. I sell this laptop. Is that revenue? No. So because I am in the business of educations, right? So the fees that come from my students is my revenue. So what is the meaning? Income received from goods or services, sale of goods or services in the normal course of business or in the ordinary course of activities is called as revenue. Okay. So understand, guys, understand what is the meaning of revenue is the income from sale of goods or services in the normal course of business, or we can say it as an ordinary course of activities. Okay. So whatever fees I receive from my students is my revenue. Okay. If I receive any other income, that is not my revenue. That is not my revenue. Okay. Now, so what is the meaning of contract? A legally binding document, a legally binding agreement or a document. What is the meaning of customers? Customer is someone who purchases or who enters into a contract with the entity. Customer is someone who enters into a contract with the entity to purchase goods or services which are sold by the entity. Again, link this with the revenue. Customers gives us revenue. So customers will buy goods or services. Customers will buy goods or services which are sold by the entity in the normal course of business or activities. Okay. So this is the meaning of the name. Now coming to the 5-step model. Understand, guys. The 5-step model. Understand the 5-step model. The 5-step model is makes the things very simple. Understand how? First is it says assess if there is a contract or not. Dekh lo contract hai ya nahi. Okay. And then it says to assess what are your performance obligations. What are your responsibilities in the contract? What are your responsibilities in the contract? Now in step 3 says first assess if there is a contract or not. Assess if there is a contract or not. If there is a contract in place, then see what are your promises made in the contract. Then see what are the promises made in the contract. Okay. Then once you identify, okay, this is my contract, these are my promises. Identify for these promises, what is the payment that you will receive? What is the payment that you will receive? Okay. Now see, read step 1. Identify whether the contract exists or not. Second, identify performance obligation. What are the promises made by you to the customer? Okay. Now third step. For these promises which you have made to a customer, what is the amount that you are supposed to receive? What is the amount that you are supposed to receive? Okay. Now step number 4. Understand. It might be a case that you have made more than one promises in the contract. It might be a case that you have made more than one performance obligation in the contract. Then in that case, let's suppose there are 3 performance obligations. Okay. In step number 2, you identified there are 3 performance obligations, and in step number 3, you identified that for these 3 performance obligations, this is the overall amount I am supposed to receive. In step number 4, what you have to do is This overall you have to break down to this one and this one. Basically you have to do allocation of the transaction price to each performance obligation. So that's what the name says, allocate the transaction price to each performance obligations. Okay, now let's suppose this, now when you make it separate, let's suppose this is satisfied, recognize the revenue for this one. This is satisfied, recognize the revenue for this one. This one is satisfied, recognize the revenue for this one. So basically you are, though the contract is one, but you are making it three. Though the contract is one, but you are separating it to three parts. Okay, and accounting for it separately. Okay, so that's what is the relevance of the 5-step model. That's what is the relevance of the 5-step model. Guys, all of you are watching the revision videos, so please I'll request you guys to like the video, okay, so that it reaches the maximum people. Now we will what we will do now is we will identify, we will study about each of the steps. We'll identify or we'll study about each of the steps now. Okay, let's understand. Step number 1. Guys, just 1 minute. If you are unable to comment, in the live chat, please subscribe to the channel. In that case, you will be able to comment. Okay. As I have said in my last class as well, due to some privacy concerns, I have to open up this window. Okay. Now understand. Step number 1: identify contract. See, for a contract to exist, though I believe you understand what is the meaning of a contract. The contract means legally binding document, a legally binding document, okay, or an agreement. Now, okay, so how will we identify whether a contract exists or not? So we have to see 5 conditions. See, don't by heart these things. You remember what are the basic essences of a contract. The contract will be approved by both the parties. Contract will state that what is my right and what is my obligation. Like let's suppose when I start teaching a student, I enter into contract with him, right? Where my right is to receive the fees and my obligation is to deliver him the lectures. Okay, I enter into contract wherein my right is to receive the fees and my obligation is to deliver the lectures, and parallelly the student's right is to receive the lectures and obligation is to pay the fees. Okay, now so then third thing, the payment terms. How is he going to make the payment? Okay, how the student will make the payment. Fourth thing, the transactions should have commercial substance. Now see, understand guys, I can do a transaction with a not for profit motive, okay, and I can do a transaction with a profit motive. Now the transaction which we are covering here is a transaction with a motive to earn profit, okay. So that's what is called the meaning of commercial substance. A transaction done with a motive to earn profit is called a transaction wherein the which has commercial substance. Now, probable to be collected. Let's suppose I have entered into contract with you guys to deliver you the lectures of SBR, okay, the regular batch. Now I'm in the process of delivering you the lectures, but from one of the student, I think that I will not receive the fees. I think that I will not be able to receive the fees. Tell me, shall I recognize the revenue from him? Tell me. No, right? I cannot recognize revenue because I am not supposed to. I am not expecting that I will be receiving the fees from him. Okay. Now, this is what. So standard says that these five conditions needs to be satisfied. These 5 conditions needs to be satisfied to classify that a contract exists. To classify whether a contract exists or not. Okay. Now comes the question: what if it fails? It can so happen, right? What if, like, see, I am saying that all the conditions needs to be satisfied. All the condition needs to be satisfied. I am saying, what I am trying to say here is that all the condition needs to be satisfied. But understand, it might be possible that any of these is not satisfied. In that case, what will I do? So standard says that what if it fails? Standard gives answer for that as well. What if it fails? Standard says you can recognize revenue. If it fails, any of these fails, provided. See, there are two cases. When you have satisfied your obligation fully, okay, we have satisfied your obligation fully, and you have received your fees fully, you have received the amount fully, okay, then recognize the revenue. Basically, the contract is wholly performed. The contract is wholly performed. Let's suppose a student came to me, told that, sir, I don't want to enter into any contract. Sir, I don't want to enter into any contract. Okay, fine. I didn't enter into any contract with him. I gave him my video lectures. He gave me the full fees. I will recognize my revenue, right? Even if there is no contract, but when the contract is wholly performed, I will recognize my revenue. Then a question should come from you. Then what it makes a difference? Existence of contract. How does it make the difference? Understand? If there are three performance obligations, so what we used to do? First, we used to identify whether a contract exists or not. Then in step number two, we used to identify three performance obligations. Step number 3, we used to identify what is the transaction price. Step number 4, we used to identify, allocate the transaction price to each of the performance obligations. And in step number 5, we used to recognize revenue as and when the performance obligation gets satisfied. Understand? If a contract is not there, will I go to step number 2? No. So what I have to do? I will not be doing this allocation part. No allocation part. When all the three performance obligations get satisfied, it is then only I can recognize revenue for that. Are you understanding this point? When all the three performance obligations get satisfied, then I can recognize the revenue for the whole amount. That's what it makes a difference. I believe you guys are understanding the difference, whether a contract exists or not. How does it make a difference? I believe you guys are understanding. Guys, understand. SBR is a paper where you are not an accountant, you are a manager, or you are a analyst, you are a financial analyst. Okay, you are not an accountant. Understand? You are a director of the company. You are analyzing the financial statements. Okay, so understand, guys. That's the reason why I'm telling that. Think not from an accountant perspective, because what we think from an accountant perspective. No, always ask why. Always ask why in SBR paper. And in answers also, we need to write why. Generally, students tend to struggle in SBR paper because they can't answer why. So think why and write why. It is then you will succeed in SBR. Okay, understand? Second point. This is the first point. If the contract is wholly satisfied and the amount is fully collected, you can recognize revenue. Now, second point. The contract is terminated and you have received some amount. You have received some amount that is not refundable. You have received some amount which is not refundable, and the contract is terminated. Let's suppose you booked the flat. Okay. Now think from the point of view of builder. Builder got a booking for a flat, and the customer paid the advance token money. Later on, after a month or so, the customer cancelled the contract. So as per the terms of basically in the general parlance in real estate industry, the token money which you give is not refundable. Okay, they will not refund you. Okay, they will not refund you. So now, if they are not going to refund you, the token money, that is an income for them. Why? Because you cancel the contract is terminated, amount is not refundable, they can recognize that as a revenue. See, that's what they are saying. Contract is terminated and the amount received is not refundable. Contract is terminated and the amount that the entity has received is not refundable. I hope step number 1 is clear to all of you. Please confirm, guys. Step number 1 is clear to all of you. Anyone having any queries in step number 1? Wonderful, Nutan. Wonderful, Arun. Wonderful. Now let's come to step number 2, that is identifying performance obligations. Till the time contract not terminated, it will be treated as a loan. Not loan, you can say a liability. You can say a liability, basically a contract liability. Okay, a contract liability, you can say. Saying loan is not wrong, Ayush, but yes, saying as a contract liability is a better term to say. It's not wrong, but a better term can be contract liability. Okay. Now understand. Step number 2, coming to performance obligations. Now, what is my performance obligations? See, I understand, guys. First, to identify that what are the performance obligations in my contract, identify the promises made. Identify the promises made in the contract. What are the promises made by the entity to the customer? Made by the entity to the customer. These are called as performance. Now, when you identify the promises, understand. Let's suppose there are 4 promises made in the contract. There are 4 promises made in the contract. I am saying promises. Understand, guys? I am saying promises. Standard says that a distinct promise to transfer goods or services called as performance obligation. Now, what is the meaning of distinct? Standard says either a distinct promise to transfer goods or services, okay, is called as performance obligation, or a series of distinct goods or services is called as a performance obligation. Guys, tell me, every day, this 5-day revision series, don't you think so? Every day I am coming at the same time and delivering lectures to you guys, and right? This is the 4th day and 1 more day is remaining. So every day I am coming and I am giving, right? So don't you think this is and every class is different from each other. Every class is different from each other. Every class is different from each other. So don't you think so? This is a series of distinct goods or services. 5 distinct goods or services in a series. Right? So that's why we say revision series coming up. Okay? So this is called a series. Now, what is the meaning of distinct is a question. See, understand, guys, standard says the goods has to be distinct on its own, or the promise has to be distinct on its own, and the promise has to be distinct in relation to other promises in the contract as well. Okay, now how? If the goods or promises which you are transferring is capable of being sold separately and being used separately, sold separately by the entity and being used separately by the customer, then we can say that this is a distinct. Then we can say it is a distinct. But what if it is not a distinct? Let me tell you. There are 4 promises. Let's suppose this is distinct, this is also distinct, but these 2 are not distinct. Or let's suppose this is also distinct, but this is not distinct. Understand, guys? This is dependent on this one. This is linked to this one. So what will I say? What will I do? I will bundle these two. And now how many performance obligations? 1, 2 and 3 rather than 4. 1, 2 and 3. So what I have to see? The distinct on its own and distinct in relation to other promises in the contract. Okay, you have to remember these 2 terms, guys. Distinct on its own and distinct in relation to other promises in the contract. Is it clear? The step 2 is clear, everyone? Tell me. Step 2 is clear to everyone? Come on, guys, please confirm. Wonderful. Understand now. Step number 3, determine transaction price. See, so far we identified that if this is a contract or not. Then we identified what are the performance obligations in the contract. Okay, what is my responsibility under the contract? Okay, then comes the third part, that is determining transaction price. But before I move on to the third part, let me take up one example for this one also, performance obligations. Okay, the example which I generally take in my regular classes as well. Let's suppose Dell has entered into contract to sell a laptop along with an standard warranty or called an inbuilt warranty. Okay, and an additional warranty Okay, so tell me how many promises? 3 promises. One is laptop, one is inbuilt warranty, and one is additional warranty. Now tell me, can additional warranty be sold separately? Yes. Can it be used separately by the customer? Yes. Can laptop be sold separately? Yes. Can laptop be used separately by the customer? Yes. Inbuilt warranty, can it be sold separately? No. So basically, the customer will neither purchase the laptop without inbuilt warranty, nor the customer will purchase the inbuilt warranty without the laptop, right? So what I have to do? They are not distinct. These two are not distinct. So what will I do? I'll merge these two. I'll merge these two, and this will become one. So I have two performance obligation in this contract. I believe you are understanding this part. Now moving on to the third step, that is determining transaction price. Now understand, guys. Transaction price can be fixed, can be variable. Transaction price can be fixed, can be variable. See, there is no challenge regarding a fixed transaction price, but there are challenges pertaining to variable transaction price. Why? Why? Because variable, when we hear the term variable, it means it is dependent upon future conditions, right? It means it is dependent upon future conditions. Understand, guys, whenever it is dependent upon future conditions, so there is a contingent thing, there is a contingency that comes up, there is a contingency that comes up. Now, due to this contingency, okay, might be there are certain uncertainties attached in the future, right? Now, how to assess that whether I can, the question that comes up is whether I can recognize variable consideration as a revenue or not, whether I can recognize this variable consideration as a revenue or not. So standard says that yes we can, but standard also attaches a condition to it. Yes we can, provided there is a reasonable assurance, or certainty that the uncertain, whenever the whatever are the uncertainties, and whenever it gets resolved in the future, whatever is the uncertainty, and whenever it gets resolved in the future, this variable consideration which you are recognizing as a revenue now will not be reversed. Basically, you have to be reasonably certain that the uncertainty attached to the variability of the consideration, whenever it gets resolved in the future, this variable consideration which you are recognizing as a revenue now will not be reversed when that uncertainty is resolved. When that uncertainty is resolved, you will not reverse this thing. Okay? So basically, though it is variable consideration, but the standard says that recognize a revenue when you think it is not variable. Though the name is variable, but recognize revenue only if you think it is not variable. Substance over form. In form it is variable, but in substance it is fixed. Recognize the revenue when in substance it is fixed. I hope you are understanding this point. Variable consideration. Come on, guys, tell me, is it clear? Variable consideration part. Now comes the question that how do we estimate the variable consideration? Guys, understand. If there is a range of possible outcomes in the future, that the variability can be 5, 4, 3, 2, 1, 4, 5, anything, right? Then we have to take expected value method. Then in that case, we have to take expected value method. That is, there is a range of possible outcomes. But now understand, sir, if one can certain, then how it is contingent? Vishaka, see here, what is the term that I used? Reasonable certainty. As of now, what do you think? As of now, what do you think? Most likely means only 2 possible outcomes. See, understand, when I am saying reasonably certain that it will not be reversed in the future, doesn't mean that it cannot get reversed. It can get reversed. But just assess if you are sure or not. Just assess. 2 possible outcomes. Okay? I hope you are understanding these parts, guys. I hope you are understanding these points. Now, variable consideration is done. Coming to part number B, that is significant financing component. Understand, guys. Significant financing component, a very important term. Okay, very important concept. Okay. Now, whenever there is a gap of more than 12 months, between the date when the consideration is received, and between the and the date when the goods or services are transferred to the customer, we say that there is a financing benefit either to the entity or to the customer. Let's suppose consideration is received before and I will transfer. I'm entity and I receive the consideration before and I will transfer the goods after 12 months. Means the entity has got the financing benefit. But let's suppose I have transferred the goods or services now, but I will receive the money after 12 months, right? So I have given the financing benefit to the customer. So either to the entity or to the customer. If there is a financing benefit, the accounting will change. Understand guys, understand. So first, the meaning of significant financing component is whenever there is a gap of more than 12 months between what dates? Tell me, between what dates? Between the date of consideration and the date of transfer of control. Okay, between the date of transfer and the date of transfer of control, if there is a gap of more than 12 months, we say that a significant financing component exists. Is it clear, everyone? Now comes the question, how to do the accounting for that. Understand guys, we also have a question on this one and we will take up a question for this also in the class. Okay, understand. Let's suppose we have transferred the goods or services here and we will receive the consideration here. Gap is more than 12 months. The question is, how will I do the accounting of it? See, I have transferred the goods or services today. But I will receive the consideration after 12 months. So what I will do? I will calculate the present value of it. At the market rate, and this present value will be my revenue. Now this present value I will unwind, and I will receive it here. Okay. So what is the entry that I will record? Tell me. So entry will be, my journal entry here will be bank account debit. Trade receivables account debit to revenue at present value. Now understand guys, this trade receivables will be at present value, which I will unwind, and come here and then realize bank account debit to trade receivables. I hope it is clear, everyone. No, Nutan, if there is a gap of 12 months between the goods transfer and consideration, it is then we record at present value. Okay. In that case only we will record at present value, not in every case. Okay, Nutan. Now coming to case number 2, understand guys. In this case, I have received the, I am the entity and I have received the consideration before, but I will transfer the goods after 12 months. I have received the money, right? So what will I do? I will record it as a contract liability. Again, by which I will unwind and record finance cost. And what I will do, I will unwind it and calculate future value at market rate, and this future value will be my revenue. Are you understanding it, guys? So what I will do here, I will record entry contract liability account debit to revenue. Please see these two entries, guys. Please see these two cases and please make yourself comfortable, because these are very, 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 very important concepts. These two cases are very important concepts, and we do have a question on this one. We do have a question on this one, which we'll take up today in that class, live class. Okay. Is it clear, everyone, so far? Can we move ahead now? Okay, fair enough. Now coming to the non-cash consideration. Non-cash consideration. Understand, guys. I delivered the goods or services to the customer, and the customer, rather than paying me the money, he gave me certain other goods or services. Comes the question that how will I value the transaction price in this case? So now understand. So my students used to say that sir, we will record it at fair value, but the question that comes up is fair value of what? The goods or services that you have delivered to the customer, or the goods or services that you have received from your customer as a non-cash consideration. Tell me. Guys. It's always goods or services received, not this one. If you are unable to estimate this one, in that case you can take this one. Okay. If you are unable to estimate fair value of goods services received, in that case you can take fair value of goods services delivered. Okay. I hope you know the logic also. The logic is, understand, guys, let's suppose I want to sell this mobile phone to you guys. Okay. You will give me 10,000 in cash. So 10,000 will be my revenue. Let's suppose you gave me equity shares worth rupees 10,000 to me. Okay. Though this mobile phone I know is worth 8,000. I can sell this mobile phone for 8,000 only. But you gave me equity shares worth 10,000. So what will I do? I will record at 10,000, right? So basically I record at what I received, not at the selling price of this product. Okay, whatever I receive, because it might be the case that from different customers I will charge different price, right? So I always recognize the revenue at the price which I receive from the customer. Okay, so it's the fair value of goods or services received, not the fair value of the goods or services delivered. Okay, please keep this in mind. Generally a student tends to make a mistake in this one, so don't make this mistake, please. Again, consideration payable to customer. Now, why entity is paying a consideration to him? Let's suppose I am receiving a consideration from Yogesh. Okay, is he here today? No. Let's suppose now Nutan. Nutan is here. Now, so I am receiving Nutan purchased my SBR classes. Okay, so ideally he is supposed to pay me the fees, and I was supposed to give him the SBR lecture. Okay, I was supposed to give her the SBR lectures, but let's suppose I am paying a certain amount of money to Nutan. Why? She told that, sir, I will help you in the content creation of your book, okay, of the IFRS book which you are writing. I will help you in that. Okay, I told fine, I'll pay you for that. So don't you think that is a separate transaction? This is a separate transaction. Will I adjust this transaction for that? No, right? I'll not adjust that, right? So it says customer also provided certain goods or services. Then in that case, ignore. Treat it as a separate transaction. Treat it as separate transaction. Now, but let's suppose Nutan did not give me any separate goods or services. In that case, what will I do? So let's suppose she gave me the fees amount, and I am giving her something, right? I am giving her some amount, means I am taking as a discount. I am giving her a discount in the SBR lecture, right? So reduce from the consideration. I believe you guys are understanding these points. Tell me please, is it clear, everyone? Now, step number 4, allocate transaction price to each performance obligation. Transaction price to each performance obligation. See guys, understand what we have studied so far. Identify the contract, identify the performance obligations, identify the contract, identify the performance obligations, identify the transaction price. Now identify the transaction price. Now what we are doing is we are allocating. We are allocating this to each of them. How? In the ratio of the standalone selling price of each of the goods or services. In the ratio of standalone selling price of each of the goods or services. In the ratio of standalone selling price. In the ratio of standalone selling price of each performance obligations, for each performance obligations, okay. Vishakha has a query, can we take the likely transaction which is in cash for measuring the revenue amount? Understand, Vishakha, she has a query from non-cash consideration, which I missed, I believe. She is telling that, let's suppose I am selling this calculator to someone, okay, and he has given me a non-cash consideration, okay, whatever it is, okay. But let's suppose I sell this calculator to someone for cash also, whatever the price he has paid me, can I take that price as a revenue for this transaction also? Is that what your query is, Vishakha? Is this your query? Okay. Tell me, Vishakha, don't you think so? Same calculator you can sell to different customers at different prices. Don't you think so? Right? So basically, now what is the revenue? So when, let's suppose the price of this, generally I sell this calculator for 400. To a customer I sold it for 500. So what is my revenue? 500. To a customer I sold it for 250. What is my revenue? 250. To a customer I sold it for 300. What is my revenue? 300. So I have to see it separately. Okay. Now, okay, yeah, but if the standalone, see here I was discussing step number 4, allocate the transaction price to each performance obligations. We allocate the transaction price to each of the performance obligations in the ratio of standalone selling price of each of the performance obligations. But the standard says that if the standalone selling price is not available, then you can take adjusted market price. Now what is the meaning of adjusted market price? In the market might be similar goods or services would have been sold, right? What is the price for that? What is the difference in the feature for this for the product which you are selling and for the product which is being sold in the market? What is the price of that? What is the change in the feature? Adjust your market price accordingly. Okay. Let's suppose I am selling this calculator. Okay. I don't know the market. I don't know the standalone selling price for this calculator. But in the market, similar calculator is sold for 400. But in this calculator has GT option. That calculator doesn't have GT option. So this calculator should command a higher price. So that calculator is being sold for 400. So I will say that the standalone selling price for this calculator can be 450. Okay. I am adjusting the market price of this one according to that one. Now let's suppose I don't know the standalone selling price of this calculator. In the market also no one knows it. Then, but don't think at least I will know the cost of this calculator. Tell me. A bare minimum, I will know the cost. I will know the margin at which I sell the products. I know the margin at which I sell the products. So I can take cost plus margin. I'll take my cost and what is my margin. So I'll take cost plus margin. Let's suppose this margin is such wide, to some customers I charge 10% margin. To another set of customers I charge let's suppose 20% margin. To some customers I charge 70% margin. So basically the margin differs from customer to customer, and that to very wide range. Generally happens in IT industries, right? Infosys might charge a negative margin to one of the customers and might charge you can say 70% margin to some customer, and might charge some other margin to some other customers, right? This happens in our practice also, right? The chartered accountants practice. We might charge different margins to different customers depending upon the nature of the clients, right? So in this case, if I don't know the margin rate, I will take a residual approach. Basically, the performance obligations, I will allocate the transaction price using the standalone selling price. Whichever performance obligation I am enabled to identify either of these, Whatever is the residual amount, I will allocate here. Whatever is the residual amount, I will allocate here. Okay. Now this is step number 4. Coming to step number 5, the last step. Understand, guys? Recognize revenue. Recognize revenue as and when your performance obligations get satisfied. As and when your performance obligation gets satisfied. You had 3 performance obligations. Let's suppose on the date of the sale itself, your one performance obligation gets satisfied. Recognize the revenue for that. Don't wait for the others to get satisfied. Okay. Let's suppose after the 1 year from the contract, performance obligation number 2 gets satisfied. Recognize the revenue for that. After 3 years, performance obligation number 3 gets satisfied. Recognize the revenue for that, and then basically all the 3 are not linked now. They are separate. Though the contract is one, but we have divided one contract into 3 parts. Are you understanding this part? Are you understanding this point, guys? Tell me. Recognize the revenue as and when the PO gets satisfied. Now comes the question. I believe you understood the recognize revenue part. Okay. The question that comes up now is PO gets satisfied. What is the meaning of PO gets satisfied? When does PO get satisfied? Standard says when the control is transferred. When the control is transferred, we can say that the PO is satisfied. Okay. But now the question comes up, when is the control transferred? Two things control, I believe I have already discussed. Control means 2 things. Right to direct the use and right to receive the economic benefits. When these 2 gets transferred, I can say the control is transferred. Certain indicators are also given in the standard. Certain indicators are like risk and rewards being transferred, or like position is transferred, legal title is transferred, right? The customer has accepted the product, or you can say the entity believes that there is a right to payment. All these are indicators of transfer of control. This is just an illustrative list, not an exhaustive list. Okay. Now, see guys, understand, control can be transferred at a specific point in time. When I purchase this calculator from a company, from a shopkeeper, for a shopkeeper, this control gets transferred at that point in time. He sold the calculator to me, he received the money, closed at that point in time. But now let's suppose you took SBR classes from me. Our SBR classes is of 32 lectures, right? So over 2.5 months, we deliver the lectures to you. Every day we deliver the lectures to you, right? Every day we deliver a distinct good or services to you. Guys. Now understand, guys, when we are delivering a distinct good or services to you guys, what is that called as? Tell me. What is it called as? That's called that the control is being transferred over a period of time. Control is being transferred over 2.5 months. Okay, so control can get transferred at a point in time, or control can get transferred at over a period of time. I believe you guys are understanding this part. But the question comes up, how to assess that? Standard gives you 3 conditions. What are those conditions? Understand. Conditions are: customer simultaneously receives and consumes the benefits as the entity performs. As I teach you guys, as I educate you guys receive the benefit and consume the benefit. Please confirm yes or no. As and when I am performing, you guys are receiving and consuming the benefits. Tell me. right? So this condition gets satisfied in the case of education, but the standard says that if anyone gets at anyone, not all, anyone, then we can say that the control is transferred over a period of time, over a period of time. Control is transferred over a period of time. But standards also goes on to say that if none of the conditions are satisfied, then the control is transferred at a point in time. Understand, guys? Customer simultaneously receives and consumes the benefit as the entity performs. Entity's performance creates or enhances an asset that the customer controls. Third one. Here I am writing or. Okay, now no alternative use of asset. I have written here and, meaning thereby this is one condition itself. Okay, one condition, two parts. No entity doesn't have any alternative use of the asset, and the entity has a right for payment for the work done till date. Let me explain it to you guys. Let's suppose Mukesh Ambani has a very let's suppose Mukesh Ambani has an open land in Mumbai, okay, and he wants to construct a house over that land. So he appoints DLF group to construct a house over that land. Now let's suppose Mukesh Ambani and DLF enter into a contract for constructing a 10-story building. Okay, now after two floors are constructed, Mukesh Ambani didn't like the quality of work, and discussed with DLF and terminated the contract. Okay, now and terminated the contract. What happened here then? Don't you think DLF will require the payment for the two floors which he has done? DLF will require the payment for the two floors that he has constructed. Tell me. Right, and tell me, can DLF use in any manner those two floors? Can DLF use it in any manner? Those two floors in any manner? Can DLF use it? DLF can use those floors? No, right? See here, this condition. Entity means DLF does not have any use of the asset, and DLF has a right for payment for work done till date. Okay, this is what this condition gets satisfied in that case. Okay, sorry, this condition gets satisfied in that case. Now, example, sale of flats. Understand, guys? Whenever you are, let's suppose, also the second condition gets satisfied, entity's performance creates or enhances an asset that the customer controls. Yes, Nutan, wonderful analysis, Nutan. Also in this case, second condition also gets satisfied, right? Wonderful. But our requirement is only one. Right? So in any case, we will recognize revenue over a period of time. Sale of flats. Tell me, when you let's suppose you are a builder and you have sold one of the flats to a customer. Okay, you are in the construction phase only, and one of the customer has booked a flat in your apartment. Okay, now tell me, can the customer, when you are performing, can the customer receive and consume the benefit? As and when you as a constructor is performing, can the end customer receive and consume the benefits? No. Is it the asset that the customer controls? No. Now, tell me, Can the entity use the asset in any manner possible till the time it is not handed over to the customer? Yes. Yes, right? Now, so all the conditions are not satisfied. None of the conditions are satisfied. None of the conditions are satisfied. In that case, it says whenever it's a sale of flat, generally, since none of the conditions get satisfied, we recognize revenue at a point in time. That is when the control is transferred to the customer. Okay. Now, construction work on the land of customer. I already took up this example, right? So already discussed. Now, tell me guys, this is all about your 5-step models of revenue. Is it clear, everyone? Can you explain second condition a bit more? See, it says that as and when I am performing, it creates or enhances an asset that the customer controls. Let's suppose I am going back to my old example. DLF is constructing a property for the Reliance, okay, for Mukesh Ambani. Now, don't you think as and when the DLF is constructing the building, it creates an asset for Mukesh Ambani? Tell me, Arun. It creates or enhances, means increases the value. I'm not saying about appreciation. I'm saying creates or enhances. Okay. Now, anyone having any queries further? We'll move on to the last part of the standard, that is a few business models. Third one also create. Third one, there is no point of creation. Third one says here that entity cannot use it in any manner. Okay, and the entity has a right to payment for the work done till date. I hope it is clear, everyone. Let's move ahead, guys. If you have any queries, definitely we can discuss it off, guys. Come on, please raise your queries if you have any. Okay, none. Understand, guys? Understand business model. So first business model is principal versus agent. Third one, revenue is point in time. Which one you are telling, Vishakha? See, what I am trying to say is, if any of these conditions get satisfied, it is overtime. Else it's point in time. Okay, I hope this is clear to everyone. Now moving on to the other business models. Okay, fine. Now the first point here is principal versus agent. Understand, guys, there are a lot of e-commerce business models coming up these days, right? And all of them, the challenge of revenue recognition comes up, right? All of them. Like I've practically seen this situation happening. Okay, during my experience in the big 4 firms, I have seen this practically happening, like in Myntra, in Amazon, right? In like all the startups, all the e-commerce startups, this challenge is there, okay? Whether the revenue or the practo, or whether the revenue has to be recognized on a gross basis or on a net basis, like make my trip, okay? Paytm, all of these are agents. They are not anything. They are just an agents, like Uber, okay, or Ola. All of them are just agents, nothing else. They are an aggregator. they are an aggregator. Understand guys, what happens is, like there is an Amazon. So what does Amazon do? He brings in the sellers, he brings in the buyers at one place and creates a marketplace wherein they can transact, they can do the transaction, okay? And he collects the commission from the seller also, from the buyer also. From both of them he collects a commission, that's all. And this commission is an income. So the question that comes up, first thing, how to identify whether he is a principal or an agent? He is a principal or an agent. Let's suppose, again giving you another example, Make My Trip. You booked a flight ticket from Make My Trip, okay? Now flight ticket is for the Indigo. But you are booking from Make My Trip, though you have an option to book from Indigo website as well, right? But you have more convenience in booking from Make My Trip, right? So you book from Make My Trip, so what happens? Let's suppose the MMT charged you 6,000 for a flight ticket. So 500 is his commission and 5,500 is the amount that it will transfer to the Indigo. It will transfer to Indigo. Okay. Now understand guys. So how to identify who is the principal and who is the agent? Who is the principal and who is the agent? So standard says that assess these three things. Now what are these three things? Understand. Who has the power to establish the price? Who has the power to establish the price? I'll write here, price establishment. Who has the power to establish the price? Who bears the inventory risk? Who bears the inventory risk? Do you think Amazon bears the inventory risk? No. It's the seller who bears it. Not the Amazon, okay? Now, who has the primary responsibility of fulfilling the contract? It's the seller who has the primary responsibility of fulfilling the contract. It's not the Amazon, okay? Now, so we will analyze these three conditions, okay? If these three conditions, for whichever party in favor of this, he is a principal. Let's suppose Indigo can establish the price. Indigo bears the inventory risk. Let's suppose the flight tickets are not full, okay? The flight is not fully booked. Will Make My Trip pay for the rest? No, Make My Trip will not pay for the rest, right? Make My Trip will not pay for the rest. So the inventory risk is borne by the Indigo. Now, who has the responsibility of fulfilling the responsibility? It's Indigo. It's not Make My Trip, right? So it's the Indigo who is the principal. And it's the Make My Trip who is the agent. Now comes the question, how will they recognize revenue? So Indigo will recognize 6,000 as revenue, 500 as commission expense, and agent will recognize 500 as revenue. Is it clear, everyone? So basically he will recognize net revenue, and he will recognize gross revenue. I believe it is clear to everyone. Now coming to the next part, consignor and consignee. Understand guys, this model used to happen and now also it happens, but not that much prevalent. What happens? Consignor wants to sell his goods, right? So he handovers a part of the goods to the consignee. He hands over the part of the goods to consignee to sell it off. On behalf of the consignor, consignor. So tell me, when the consignor is giving the goods to the consignee to sell, is the control transferred from consignor? When the consignor gives its goods to the consignee to sell on behalf of consignor, is the control transferred? No. But the control gets transferred when the consignee sells it to the end customer. Okay, so it is then the control gets transferred. Now comes how will they recognize revenue for this? So answer for that is, see, consignor is a principal and consignee is an agent of is an agent of consignor. Is an agent of consignor. Is an agent of consignor. He is an agent of consignor, right? So he will recognize net revenue and he will recognize gross revenue. Is it clear, everyone? Is it clear, everyone? Tell me, guys. Now, moving on to the third point, warranties. Warranties. Guys, understand, warranties, the three conditions need to be fulfilled here as well. Understand, standard doesn't say that all the three conditions has to be satisfied. Standard doesn't say that either it's all or any one. No, standard doesn't say that. Standard says that you have to see substance. You have to see substance of the contract. There can be cases that only two conditions are being satisfied, and you can conclude on the basis of that. Okay, because ideally it will not be the case that all the three conditions are being satisfied. Okay, you have to see the substance of the contract. You have to see the substance of the contract. Okay, and then accordingly analyze it. Now, and yes, the three conditions need to be satisfied here as well. The three conditions need to be satisfied here as well to analyze whether the consignee is an agent or is a customer. Is an agent or a customer. I'm not saying agent or principal. I'm saying agent or a customer, because if consignee is acting as an agent, then the control doesn't get transferred here. But if the consignee is acting as a customer, the control gets transferred here. So I have to assess whether it's a principal agent relationship or it's a supplier and it's a entity customer relationship. I have to assess whether it's a entity customer relationship or it's a principal agent relationship. Okay. Does this answer your query, Vishaka? Okay, understand. The third point is warranties. Warranties. Guys, understand, warranties can be a separate performance obligations, cannot be a separate performance obligation. Like for the, remember the example which I gave in the performance obligation step number 2, inbuilt warranty and additional warranty. And I told that inbuilt warranty is not a separate performance obligations, but additional warranty is a separate performance obligation. So I lied here. See, although I have written here also that separate performance obligation means additional warranty is a separate performance obligation. Example is additional warranty, and example here is standard or inbuilt warranty. So if the warranty is a separate performance obligation, if the warranty is a separate performance obligation as per step 2 of 5-step model, then you have to apply 5-step model and recognize the revenue accordingly. But if it is not a separate performance obligation, then what you have to do here is you have to recognize provision under IAS 37. You have to recognize provision under IAS 37. Understand, guys? Whenever it's a separate performance obligation, means you will receive something for this. You will receive something for this from the customer. So there is a cost, there is a revenue. So recognize revenue and cost separately. Recognize revenue and cost separately. But if it is not a separate performance obligation, means in the future I am bound to incur the cost for which I will not receive any revenue from the customer. I am bound to incur a cost in the future for which I will not receive any revenue from the customer. And hence you have to create a provision. You have to create a provision under IAS 37, right? Because this creates a present obligation. Understand, guys? This creates a present obligation. Okay, which arising out of past event, that is sale. The amount can be estimated. Amount of which can be estimated. And hence you have to create a provision under IAS 37. I believe it is clear to all of you now. Warranties are clear to all of you now. Now the sale with a right to return. Understand, guys? Sale with a right to return means what? In Amazon, when we purchase goods or services, think from the customer point of view now first. Do you think we have a 10 days replacement policy? we have a 10 days replacement policy. Tell me. Now, have you ever wondered, that how Amazon recognizes revenue? How Amazon recognizes revenue for this? Tell me. How will Amazon recognize the revenue? So the standard says that whenever the goods are sold with a right to return basis, entity, the Amazon will estimate on the basis of past records that what are the goods which will come back to me. What is the percentage of goods that will be returned? What are the percentage of goods that will be returned? Okay. What are the percentage of goods that will be returned? Okay. It makes an estimation. It makes an estimation. So basically, firstly it recognizes the full amount as revenue and cost of sales. Then it assesses the expected return percentage and reverts the revenue and cost of sales. To the extent of expected returns. So what is the entry that it passed? See, bank account debit, because when the Amazon sales, it receives the money. It will recognize the whole amount as revenue, but the percentage, expected return percentage, to the extent of expected return percentage, they will recognize it as a liability. I am not recognizing as a revenue, but since I have received the money, I am recognizing as a liability. To the extent of return percentage. Similarly for cost of sales also. See, though I have transferred the goods to the customer, so inventory will get reduced. I have transferred the whole goods to the customer, so my inventory will get reduced. But I can recognize cost of sales only to the extent I am probable that the goods will not be returned. So to the extent that I am expecting that the returns will be there, I will recognize a right to return asset. I will recognize a right to return asset. Now, on the date when the return period expires, there can be two possible cases. Either the goods are returned. If the goods are returned, what will you do? You will, if the goods are returned, you will pay the amount back. When you return the goods, you have to get a refund also, right? So the entity will refund the money, and whatever is the R2R, it will record an inventory for that. Right to return asset, it will credit. See, it is debited here. Whatever is debited here, it gets credited here. It gets debited here. See here also. Refund liability gets debited here. Okay, to bank, to RTR asset. Now understand, guys. If it is not returned, basically these refund liability and R2R asset gets reversed. Understand? If it is not returned, what will I do? I will recognize the balancing figure which I didn't recognize as the revenue. I will recognize that also as a revenue now. So refund liability I will reverse and recognize the revenue. R2R asset I will reverse and recognize as cost of sales. I believe it is clear to all of you now so far. Yeah, I believe it is clear to all of you. Fair enough. The last point here, the revenue standard, the last point is repurchase agreements. What is the meaning of repurchase agreements? Means I have sold certain goods to you, and in the contract I am writing that I have a right to repurchase. Now let's suppose, forget this one. You know these repurchase agreements. Every one of you know. Even if you don't study repurchase agreements, you know it then also. Answer with the logic. I sold goods to you for ₹100. I sold goods to you for $100. And in the contract I have written that I have a right to repurchase. The same asset which I have sold, I have a right to repurchase it from you at 110 after 1 year. And you will not use the asset. Tell me, what is it? What is it called as? Tell me. What is it called as? Loan. Wonderful answer, Yogesh. I used wonderful answer. It's a loan. Basically, see, when I sold the asset, I received the money. I got the money. $100. I got $100. I got. When I am repurchasing it, When I'm repurchasing it in the future after 1 year, I will give you 110. And I'll take the asset back. So now I am receiving 100 and then I will pay 110. So it's a loan agreement. No, Vishaka, it's not lease and sale back. No, it's not lease and sale back. There is no concept of lease and sale back. It's a sale and lease back. There is no concept of such. Okay. See here. Sold to the customer. I have sold the goods to the customer. Okay. I have sold the goods to convert the right to repurchase at a higher amount. Don't miss this term. At a higher amount. This is a loan agreement, or I can say a financing agreement. This is a financing agreement. This is a financing agreement. Case number 2. Entity sold the goods to the customer with a right to repurchase at lower amount. Means, understand, I have sold the goods to you. at $100, and after 1 year, I will repurchase it from you at $90. Means I got 100 now. And after 1 year, I have to pay 90. Means I got net. I got 10. And you got the right to use the asset for 1 year. I got $10, and you got the right to use the asset for 1 year. So it's a lease transaction. It's a lease arrangement. Why will someone repurchase higher amount after using? Very good question, because that's a financing arrangement. And I told that the customer will not use it. If you can recall, I told that the customer will not use it. Okay, no use. So basically, I have given my assets to the customer as a mortgage and taken loan. And I have given the assets to the customer as a mortgage and I have taken loans. Okay. Yes, we will record interest cost on this also. We will record interest cost on this one. Okay. Now, coming to the topic 2 for the day. Okay, before we start topic 2, if we have any queries in the revenue, we have completed our revenue chapter, guys. If you have any queries on revenues, let's discuss it off. Now, lease agreement, can you explain? Understand, I sold the asset at 100. So means I got 100 now. I got 100, I gave the asset to him. I got 100, I gave the asset to him, right? Ahana, is it clear till here? Ahana, is it clear till here? I got 100, I gave the asset to him. Clear? After 1 year, I am repurchasing the asset from him at $90. Means what? I will pay him 90 and I will take the asset back. Means earlier I received 100. Okay, understand it this way. Though I am writing it here, but I will remove it off. Entity customer. At the time of sale, it received $100 and it gave the asset to him. Okay, it gave the asset to him. Now, at the time of repurchase, the asset comes back. The asset comes back and he pays 90. So what it receives? Tell me what it receives. $10. And what does customer get? The right to use it for 1 year. So don't you think so? Use and he is receiving $10 for using it, for giving him the right to use. So that's the reason why it is a leasing arrangement. I believe it is clear to you. The second one is a sale and a lease back. No, Vishaka, it's not a sale and lease back. It's not sale and lease back. Am I saying that I am selling and taking the asset back on, I am taking on lease? No, I am saying that I am giving on lease. Vishaka, I am saying that I am giving on lease. I give the asset, and I give the asset, I take the asset. Between this period, the gap is 1 year, right? This is the period of use for the customer. This is the period of use for the customer, right? And for this, for giving him the right to use for 1 year, I am getting $10. So I am a lessor, not a lessee. I am a lessor, not a lessee. The entity is a lessor, not a lessee. Not a lessor, sorry. Lessor, not a lessee. Is it clear now, Vishaka? Yes. Okay, I'll keep this diagram as it is, if anyone wants to refer it off. Can we move on to the topic 2 for the day, impairment of assets? We completed our revenue discussion in 1 hour and 15 minutes. That's not bad. That's not bad. Generally, we take 3 classes around 8 to 9 hours in the regular classes for revenue. Okay. Topic 2, impairment of assets. Topic 2, impairment of assets. Understand, guys. What is the meaning of impairment of assets? What is the meaning of impairment of assets? What is the meaning of impairment of assets? Basically, see, guys, understand what is the meaning of recognition principle for all the non-current assets, whether it is a property, plant and equipment, or an intangible asset, or investment property. What is the recognition principle? That future economic benefits are probable. Future economic benefits are probable. What if I say that future economic benefits are not there? What if I say that the future economic benefits are not there? I will de-recognize the asset. I will de-recognize the asset. What if I say that future economic benefits are there, but not to the extent of the carrying amount? My carrying amount is 100 and my future economic benefits are only 90. I will de-recognize 10. I will de-recognize 10, and this 10 is called as impairment loss. And this 10 is called as impairment loss. Okay, to the extent the asset doesn't have future economic benefits, I will de-recognize this asset, and this de-recognition is called as impairment loss. I believe you guys are understanding the meaning of impairment. If you understand the meaning, the rest part is very, very, very easy. This topic, I believe, impairment of assets, is not a topic of professional level paper itself. It's a topic of FR level, except for one point, that is impairment of goodwill. Otherwise, all the topics are rest very, very easy, very easy. Okay, now understand. So whenever your carrying amount is in excess, okay, I think I have written the reverse. Whenever your carrying amount is in excess of recoverable amount, you impair the excess part of carrying amount. You recover the excess part of carrying amount. Okay, and this de-recognition of the excess part, is called as impairment loss. So that's what I've said here. Excess of carrying amount over recoverable amount is called as impairment loss. Now the question comes up, how to calculate carrying amount? I believe you already know, as per the relevant IAS, that is IAS 1638 or 40, that is PPE, IA, or investment properties, right? Now the question that comes up here is, the main question is how to calculate recoverable amount. Understand? very much logically, understand it's logically. Let's suppose, understand this, forget, don't see the screen, don't see the screen, don't see the screen, just focus on me, see here, see here, see here, see here, my hands, my hands, my hands. Understand guys, let's suppose I have this mobile phone, I have this mobile phone, I have this mobile phone. I assess that if I am going to sell this mobile phone, I will get 12,000 out of it. If I sell this mobile phone, I'll get 12,000 out of it. But if I continue using this mobile phone, I'll get a benefit of 10,000 from this. I'll get a benefit of 10,000 from this. Tell me what shall I do? Tell me what shall I do? Tell me what shall I do? Use it or sell it? If I will sell it, I will get 12,000. If I will use it, I'll get 10,000. What shall I do? Use it or sell it? Sell it now. That's what it says. See here. Recoverable amount is higher of fair value or value in use. What is the meaning of value in use? What is the value you will get if you use the asset? What is the meaning of this one? What is the value we will get if you sell the asset? So you will take higher, obviously, right? All of it will sell. Why? Because in the sale the value is higher. In the sale the value is higher, right? So that's how I calculate the recoverable amount. Is it clear, everyone? The meaning of recoverable amount? Is it clear, everyone? The meaning of recoverable amount? Now, let's understand the meaning of fair value less cost of disposal and the value in use separately. 1 minute, guys. Just a minute, please. Thank you. Having back-to-back classes today also, so this is my 3rd class today, so a little bit throat problems. Okay, now understand. Fair value minus cost of disposal. Fair value minus cost of disposal. So how will I determine the fair value and how will I determine the cost of disposal? Understand. So fair value is as per IFRS 13. Fair value is as per IFRS 13. Okay, fair value is as per IFRS 13. Now, how to determine fair value as per IFRS 13? That we will definitely discuss in the today's topic itself, because in the today we have to discuss what is the fair value. Okay. Now, the question comes up, and in the exam they will also give you the fair value. Okay. Either they will give you the fair value or they will ask you to apply the principles of IFRS 13 and find out the fair value. Okay. They will give you either ways. They will give you either ways. Or cost of disposal. Cost of disposal. What are cost of disposal? It can be any directly attributable costs. Like legal duty, legal charges, stamp duty, or any other cost, any other transaction cost, any other transaction costs. But understand, guys, there is a catch. There is a catch here. There is a catch here. What is the meaning of fair value as per IFRS 13? What is the meaning of fair value as per IFRS 13? Tell me. It says that the fair value as per IFRS 13 means selling price of the product minus the transportation costs. Selling price of the product minus the transportation costs. Selling price of the product minus the transportation costs. Now, understand. If I have already adjusted transportation costs here, will I take transportation costs here? In the cost of disposal, will I take it separately? Tell me. In the cost of disposal, will I take it separately? No, right? Because it is already adjusted here. Right? But you have to be very careful. If the question uses the term, fair value, it is then you will not deduct transportation cost. Why? Because the fair value is already adjusted with the transportation costs. If the question uses any other term like sale price or market price, any other term, you will adjust it. You will adjust the transportation costs. Is it clear, everyone? Yes, transaction costs, not transaction. I'm not saying about transaction. I'm saying transportation. Okay, transaction cost can come here. Cost of disposal can include transaction costs, right? Like legal cost, stamp duty, all these are transaction costs. Transaction cost will anyways be deducted. Okay, transaction cost, any directly attributable transaction costs, you will definitely exclude it off. We'll definitely adjust here. But I am talking about transportation cost I use. Okay. Yes, legal cost is also a transaction cost. See, understand? There are two things: transaction cost, transportation costs. Transaction costs I will definitely adjust here. Transportation costs I will not adjust if the question uses the term fair value, because the fair value is already adjusted with the transportation cost. If the question uses any other term, we will adjust transportation costs. Is it clear now? From fair value, yes, now. Okay, let me take up an example for you. Let me take up an example. Understand? See here. Question says that fair value is $100, okay, and legal costs is $20, and transportation costs is $25. So tell me, what is fair value minus cost to disposal? So answer will be $100 minus $20 is equals to $80. I am not adjusting this one. But if the question would have said, apart from fair value, if the question would have said market value, then I would have written here $100 minus $20 minus $25 as 55. Is it clear now? Now comes the fourth point, that is value in use. Value in use. Value in use is if I use the asset, what is the value of the asset? If I use the asset, what is the value that I will generate from the asset? It is calculated as present value of the future cash flow from the asset. So now understand two things: how to calculate present value and how to estimate future cash flows. So future cash flows will be future cash flows from using the asset, and from the residual value of the asset, that is at the end of the life of the asset. If I will sell the asset, what is the value I'll get? Okay, so these two are the cash flows, and the present value I will calculate using pre-tax rate or weighted average cost of capital of the entity. Now understand, few guidance given by the standard. Cash flow which will take for the future cash flows will be only for the 3 to 5 years. You can take more if it is justified. In the cash flows, do not adjust finance costs or tax costs. In the cash flows, do not include any major restructuring costs, and in the cash flows, do not consider any recognized liabilities. Okay, just keep in mind these things. Keep in mind 4 things you will not adjust. 4 things: finance costs, tax costs, major restructuring costs, and recognized liabilities. 4 things you will not adjust in the future cash flows. 4 things which will not adjust in the future cash flows. Do not adjust. Do not adjust this, guys. Okay. Now coming to 5th point, that is impairment loss of an asset. Understand, guys. As I have already told, if the carrying amount is in excess of recoverable amount, the excess is impaired. Excess is impairment loss. Okay. But will I test the asset for impairment every year? No. I will test the asset for impairment only and only if the impairment indicators are triggered. The impairment indicators can be internal to the entity, can be external to the entity. Like for example, external is technological advancements, internal can be physical damage. Okay, so let's suppose I am using this tablet for my classes. Now there is a new technology coming in the market. Okay, from the app itself, the live class can go on, and from the app itself, you can use it there itself. You can use the platform and teach off. Okay, there is a new technology coming up. So the value of my assets will go down. The value of my assets will go down. Technological advances in the market. Now, is it clear everyone so far? Is it clear everyone so far? So this is how I have to calculate the impairment loss. This is how I have to calculate the impairment loss. Few important terms I'll write here so that I don't want to miss those terms. Few assets. Understand, guys? Assets which are to be tested for impairment every year, that is annually on the same date. At the same time. Okay, these are goodwill, these are intangible assets with indefinite life, indefinite life, development assets. Why? The reason is these assets are not amortized. These assets are not amortized. Hence, these assets has to be tested for impairment every year, irrespective whether impairment indicators are triggered or not. I have to test it for impairment annually. It's an annual exercise. Generally, impairment is not an annual exercise. The assets are tested for impairment. Understand, guys? Generally, the assets are tested for impairment only when there are impairment indicators. But for these three assets, I will test the asset for impairment every year, irrespective of whether the impairment indicators are triggered or not. Irrespective of that fact. Okay, doesn't matter. Is it clear, everyone? Is it clear, everyone, till here? Is it clear, everyone, till here? Please confirm, guys. Development assets. Let's suppose there are this, research and development, right? So in the research phase, whatever expense we incur, I transfer it to P&L. In development phase, whatever amount I incur, I transfer it to I capitalize those, but I am not depreciating those. Okay? I am not depreciating those. I start depreciations when the asset is fully capitalized and starts giving me benefits. Then I depreciate the asset, right? Or I amortize the asset. Okay, so till then it has to be tested for impairment every year. Now, understand, guys. Goodwill. Is it for a specific asset? Is goodwill for a specific asset? No. Goodwill can be for a specific division, or you can say CGU, or you can say CGU, cash generating unit. I believe all of you know the meaning of CGU, and I don't need to explain that part separately. CGU are the smallest identifiable group of assets capable of generating independent cash flows. Smallest possible group of assets capable of generating independent cash flows. Okay. Now, the goodwill cannot be for an asset. It can be for a CGU. I'll write it rather than writing division. I will write here CGU. Can be for a specific CGU, or can be for an entity as well. Okay. Now, if it is for a CGU, it's fine. But what if it's for an entity? So the question that comes up, entity means multiple CGUs. Entity can be one CGU, entity can be multiple CGUs. Okay. We'll take up a question on this. Don't worry. Okay. See, understand. if it is for one CGU, if it is one for one CGU, we'll test the CGU for impairment. We'll test the whole CGU for impairment, because we cannot test the individual assets for impairment, right? Because individual asset is not capable of generating cash flows. If they are not capable of generating cash flows, I will not be able to calculate value in use. If I am not able to calculate value in use, I will not be able to calculate recoverable amount. If no recoverable amount, no impairment loss. Okay, so hence I have to test the whole CGU for impairment. Now, if the goodwill is for the whole entity, that is having multiple CGUs, it can be allocable, it can be not allocable. Means goodwill can be allocated to each CGU. It can be the case that they can be allocated. It can be the case that they cannot be allocated. Now, how will I do in these cases? See, if it is allocable, better, good. I will allocate to all the CGUs and test the individual CGUs for impairment. Okay, whichever CGU I want to test it for impairment, I can do that. But if it is not allocable, then what will I do? First, I will impair the individual CGUs without the unallocable goodwill. Then I will test the larger CGU, that is a group of CGUs, the smallest possible group of CGUs on which the goodwill can be allocated. Okay, it can be entity as a whole as well. Okay, then I will test the larger CGU for impairment. Now, point number 7 comes corporate assets. Point number 7 is corporate assets. What are corporate assets? Corporate assets are the assets basically which is helping all the CGUs, multiple CGUs. Like let's suppose ITC has an office in Kolkata, at Kolkata. That office is a corporate office of ITC. Okay, or a head office of ITC. It supports all the divisions: packaging division, tobacco division, paper division, restaurants division. It supports all the divisions, right? And generally, see, there can be cases it can be allocable, it cannot be allocable. If it is allocable, well and good. If it is not allocable, then again we'll have to apply same logic, right? So I've written here for corporate assets also same logic applies. As goodwill, same concept as goodwill. I write here as goodwill. Now let's see this example. Okay, let's see this example and try to solve it. Okay, which will give you a very good understanding of the allocable and unallocable. See here. Such group is made up of 2 cash generating units. Goodwill unallocable when value in use cannot be computed. Vishaka, understand, see this question, you will get better understanding. Such a group is made of 2 cash generating units as a result of combination of various past 100% acquisitions, okay. 2 CGU are there, okay, plus a head office which was not allocated, means it is unallocable, okay, to any given CGU, as it supports both the divisions. Due to falling sales as a result of economic crisis, an impairment test was conducted at the year end, and the consolidated statement of financial positions showed the following net assets. So this is the carrying amount given. This is the carrying amount. This is the carrying amount given. Carrying amount is given. So carrying amount is this one. I'll write here rather than writing here. I'll write here. Sorry. Understand, guys, this is the carrying amount, okay. Now recoverable amount, tell me what is the recoverable amount, division A, 1000. So what is your impairment loss? Tell me. 20. Tell me, how do we allocate this impairment loss? First we allocate to specifically impaired asset. Is there any specifically impaired asset here? No. So what will I do? I will allocate it to fully goodwill, allocable goodwill. See, this is allocable goodwill. and this is unallocable goodwill. This is unallocable goodwill. See here, this is unallocable goodwill. Okay. Now I will impair this. So how much it becomes? Tell me how much it becomes. It will become how much? Tell me. I will impair this by 20. It will become how much? It will become 40. It will become 40. Okay. Now here, what is the recoverable amount? 720. So what is my impairment loss? 40. So what will I do? First I will impair this fully, so it will become 0. The remains is 10. So can I impair the current assets? No. So what I'll do, I'll impair this one. I'll impair this one. So it will become how much? It will become 610. Is it clear? Is it clear? Now, so this is what? So division A, division B impaired. Now I will test the whole of the CGU, whole of the entity for impairment. So what will I say? Tell me. I will say the whole PPE is how much? Tell me. 1480. The whole goodwill is how much? 40 plus 10, 50. The whole net current assets is how much? 180. Does it see? This remains the same, 310. So can you please add it up? 1480 plus 50 plus 310 is 1840 is the carrying amount. 1840 is the carrying amount. And now what is the recoverable amount of the group? 1825. So what is the impairment loss? What is the impairment loss? Impairment loss is 15. Impairment loss is 15. Now see here, read this line. Head office PPE at fair value is 85 million. Fair value, let's call it 85 million. See, it is recorded at what? 90 million. So I will, from this 15, I will first impair the head office building. First impair the head office building at 5 million. Right now, what remains? What remains? 10 million. 10 million. I will impair it to goodwill. I will allocate it to goodwill. So I will allocate it to goodwill. So this is how I will do the impairment test. Is it clear, everyone? Is it clear, everyone? Tell me, guys, is it clear, everyone? Fair enough. Now understand. Allocation of impairment loss. So we will first allocate to the specifically impaired asset, then we will allocate to goodwill, and the remaining non-current assets, I'm writing a non, I'm not writing current here. I'm not writing current, I'm writing non-current assets in the ratio of their carrying amounts. But understand, guys, this is a very important point which I'm discussing now. Very important point. Very, very, very important. Except these. Why? Because they are out of scope. Of IAS 36. Except deferred tax assets, financial assets, investment property at fair value model, biological assets, and non-current assets held for sale. Yes, Aditya, in division B, it's first goodwill because we always impair goodwill first. And then the remaining assets. See the rules of allocation, right? First we impaired to specifically impaired. In division B, there were no specifically impaired asset. Then we allocate the whole loss to the goodwill. Whatever is the impairment loss, we allocate it to goodwill. Okay, see here. We had a loss of 40, but the goodwill was only 30. So I impaired it fully. Then the rest of the non-current assets, I will in the ratio of carrying amount. So there is, ideally I will do in the ratio of carrying amount. But there is only one non-current asset, property, plant and equipment. There are no other non-current assets. So why will I calculate the ratio? I will allocate the rest to the PPE. Is it clear, Aditya? Okay, fair enough. So basically, always remember, I am writing it again. Always remember, This is a very, very important point. $180, from where 180 comes? Division B, the carrying amount was 760, the recoverable amount 720, the impairment loss is 40, right? So impairment loss 40. From this I will first impair the goodwill. First I will impair the goodwill, that is 30, right? Remains 10. I will impair the PP by 10. It is not non, see, it is net. It is net. It is net current assets, not non-current assets. Aditya, it's net current asset. It's not non-current assets. Okay. Now, point number 10 is a reversal of impairment loss. Guys, understand, if there are impairment indicators, we impair the asset. But when these indicators gets reversed, when these indicators, no worries, Aditya, when these indicator reverses, I will have to reverse the impairment loss as well. But the question comes, to what extent? To what extent? Understand. Standard says reversal can be done till to the extent of lower of carrying amount if the asset had never been impaired, or the recoverable amount. But why the standard says lower of? Why lower of? See here. See this graph, guys. See this graph. This was the cost of the asset, and if the asset would not have been impaired, if the asset would not have been impaired, if the asset would not have been impaired, your asset would have been depreciated in this manner. Your asset would have been depreciated in this manner, okay? From 100, 80, 60, 40, 20, 0. But since I impaired the asset, I have impaired the asset, okay, then it will move like this. Now here, if I want to reverse the impairment loss, standard says that when you are reversing your impairment loss, you can go only till this year, till this extent. You cannot go beyond. That. Even if the recoverable amount is higher, you cannot go beyond that. Okay, you have to remain to your cost itself. You can recognize the remaining, but using the fair value option in IAS 16 or 38 or 40, but not using IAS 36. This can be called as fair value gain. This cannot be called as reversal of impairment loss, because you can reverse what you create. You cannot reverse what you have not created. I hope you are understanding it. This part. But what if your recoverable amount is here only? So reverse till here itself. But if your recoverable amount is higher here, then max is here. This is the max limit. I believe it is clear, everyone. Now, the last note, it says that goodwill once impaired can never be reversed. You cannot reverse the impairment loss created on goodwill. You cannot reverse the impairment loss that you have created on goodwill. You cannot reverse. On assets, on non-current assets, yes, you can reverse. On head office or corporate assets, yes, you can reverse. On corporate assets, you can reverse. On all other assets, you can reverse. I write here, on all other assets, including corporate assets, it can be reversed. Impairment loss can be reversed. . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 . 1 that is separate, Aditya, that is covered in that standard. Okay, let's not merge these two. That is covered in that standard, but the logic is this one itself, but it is covered in that standard. Logic is this itself. This is how you reverse the impairment loss that you create for IFRS 5, that is non-credit assets held for sale. This is the way which you create. Okay, but it is covered as part of that standard, not here. Okay, I believe it is clear, everyone. I believe it is clear, everyone. We have revised impairment loss in mere 35 minutes. In mere 35 minutes. Okay, so let's take a quick break of 5 minutes, and then we'll resume back our further discussions. Okay, which is fair value measurement, ethics, which is fair value measurement, ethics, and a question. Okay, ethics and a fair value measurement and a question. Okay, so let's discuss it after a break. Let's resume back, guys. Now the topic which we are starting is a very small topic, very easy topic, but yes, relevant for the exams. Fair value measurement, okay, which is covered as part of IFRS 13. Understand? It covers all the assets and liabilities. Except inventories, share-based payments, leases, and value in use, because the standard says that they have their meaning in separately discussed, okay, covered in their standards, in respective standards. Understand? I'll tell you. Inventories, we calculate NRV. The meaning of NRV is given in inventories itself. Share-based payments, fair value of the options. This calculation of fair value is given in share-based payment itself. In leases, we calculate present value. Of the lease liability. The how to calculate is given in the leases itself. Value in use. How to compute is given in the IAS 36 itself, right? We discussed the guidance on IAS 36, the guidance on value in use, right? We discussed the guidance on value in use. Let's understand the meaning of fair value now. Guys, this is our second last class. Tomorrow will be last class of our revision session, and I will definitely guide you with how you have to go ahead for your exams. Like it's just, you can say, last 10, 15, 12 days are remaining for the exam, okay, and how you have to study in this. What should be the study plan? I will be discussing that, okay, tomorrow. Now, meaning of fair value, the exit price. It means the exit price. But what does it mean? How to define a fair value? It says the price which I can realize from an asset, or I need to pay to settle a liability. The price which I will realize from an asset, or the price which I will have to pay to settle that liability in an orderly transaction. What is the meaning of orderly transaction? Meaning thereby, let's suppose me and you, okay, me and Aditya, since you are my student now, okay, and you're selling something, when I come to you and purchase, you might be influenced. Oh, Vishal sir is purchasing, so you might give a discount to me. So that is not an orderly transaction. When we talk about orderly transaction, means two independent parties are transacting. Okay. Now, so in an orderly transaction, okay, to a price that I will realize for selling an asset, or I will have to pay to settle a liability in an orderly transaction, means two independent and knowledgeable parties. Two independent and knowledgeable parties, orderly transaction with market participants on a measurement date, on the date when we have to measure the fair value. On that date, what is the price at which I can realize that value of asset or settle a liability? What is the amount that I have to pay or receive to realize asset or settle a liability is called as your fair value. And in one word, if you have to say what is a fair value, this is your exit price. The price which you have to receive to exit from the asset, or the price which you have to pay to exit from the liability, is called as fair value. Now comes the question, how to measure the fair value? Understand? First, at the first instance, you have to identify the asset and a liability which you want to fair value. Then you have to identify the highest and the best use. See, understand guys. This calculator I am using in the class. Okay, or this is not the best example. Okay, I'll give you a different example. I have a land here. I have a land here. Okay, just beside my home. I have a open land here. Okay. Okay. If I open a commercial space there, okay, it will be valued at you can say 10 crores. It will be valued at 10 crores. Okay. But if I open a residential place there, okay, it will be valued at 8 crores. I am using it for agriculture. I do farming there. And if I continue doing farming there, it will be valued at 2 crores for me. Comes the question, what is the value? If I am doing farming and if I continue to do farming, it will be valued at 2 crores. If I make a commercial building on that, it will be valued at 10 crores. If I make a residential building on that, it will be worth 8 crores. Standard says what you are doing doesn't make sense. Think from a global perspective. Highest and best use is not entity specific. It's not entity specific. Rather, it is asset specific. What are the possible uses of the asset and what are the restrictions of that? What are the possible uses and what are the restrictions, and accordingly value it off. Okay, so for this asset which I told that if I am continue to do farming, it is valued at 2 crores. If I make a residential building, 8 crores. If I make a commercial building, 10 crores. I will say the fair value of the land is 10 crores, not 2 crores, because the highest and the best use is the commercial space. Is it clear? Are you understanding this part, everyone? Are you understanding this? When I am assessing the highest and best use, I will see the physical factors, I will see the legal factors, I will see the financial factors. Is it clear, everyone? Come on guys, please confirm. So I have discussed 2 steps so far. Identify the asset and liability, and then identify the asset highest and best use. Is it clear, everyone, so far? Please confirm, all of you guys. Come on guys, please confirm. Why did at the time of mid of the class you guys go low on energy? Come on guys, be motivated. High on Joes. Tell me, is it clear, everyone, so far? Okay, fair enough. Now, the third point, identify the market and market participants. Now, who are market and who are market participants? See, understand, the standard says that market can be 2 types. Market can be of 2 types. One is the principal market and one is the most advantageous market. Okay. So you should give preference to market, principal market, and if principal market you are not able to identify, then you can go for most advantageous market. Now, what is the meaning of principal market? The market in which that asset is sold in sufficient volume and you don't have any restriction to reach that market. Let's suppose if we talk about any software, Bangalore is the principal market. For any softwares, Bangalore is the principal market. Okay, Bangalore is the principal market. Let's suppose take about any video editing softwares, video editing equipments like camera, you can say the lighting systems. Okay, Mumbai is the most principal market. You can say the principal market. Mumbai is the principal market, right? Mumbai is the principal market for that. So you have to identify the what is the principal market based on where that asset is sold in sufficient volume. Now, then what is the meaning of most advantageous market? Which market? Sufficient volume for entity or for the business? Neither for the entity nor for the business. Significant volume of the asset. Let's suppose I want to sell this. Land. Land, we have restrictions. Let's suppose I want to sell software. Where are softwares sold significantly? Tell me, where are softwares sold significantly? Bangalore, right? If I have to sell any camera, or any video editing equipments, okay? Any filming equipments, Where is it sold? Frequently and with significant volume. The asset, see, I am talking about the asset. I am not talking about the entity or its any of its business. I am talking about the asset. Where is it asset? Sold with significant volume. That's Mumbai, right? So I am talking about the asset. I am talking about the asset. What is the meaning of most advantageous market? Most advantageous market means in which market I will get the highest value. In which market I will get the highest value is called as most advantageous market. So I will give standard says you have to give priority to principal market. If principal market is not available, then you can first priority, then second priority. Okay, if principal market is not available, then you can go for most advantageous market. Check the market of a specific asset. Yes. Okay, I'll write here of the asset under consideration. Asset or a liability under consideration. Of the asset or liability under consideration. Okay, now understand. Step 4. See, you have identified the asset. You have identified what is the highest and best use. You have identified the principal market or the most advantageous market. You have identified that, right? And now you will apply the valuation techniques. What are valuation techniques? It can be market based. That what is the market or what is the market price of the similar asset. It can be cost based. What is the cost of the asset? It can be income based. What is the future cash flows? Let's calculate the present value of that. Okay, now and I apply valuation techniques and calculate fair value. How will you calculate fair value? Price, what is the price? Price as per the valuation techniques. As per valuation techniques that you applied here, okay, minus transportation cost, but you will not deduct transaction cost, because whether to deduct transaction cost or not, it is covered under respective standards. Let's for example, IAS 40 says only fair value. IAS 36 says fair value minus cost to disposal. IAS further you can say not IAS, IFRS 5. IFRS 5 says fair value minus cost of disposal. Okay, so different standards may give different guidance. So that we are not covering. Transaction cost we are not covering, but transportation cost is deducted from fair value. We discussed it right now also, right? Now, presentation or disclosure. The disclosure in FS. See, wherever we use fair value, all the fair values has to be disclosed in 3 levels. Either the asset can come in level 1 or level 2 or level 3. So we have to classify. I have to classify the assets under these 3. How? If the fair value is determined using the quoted market price, let's suppose investment in equity shares or mutual funds, right? Quoted mutual funds, all those things we will say it as a level 1. If the quoted price is not available for that same asset, see, I have written here identical, and I have written here similar. But for similar assets, quoted price are there, okay, or observable market inputs are there, then I will say it is level 2. But there are no observable inputs there. We have computed the fair value. Then we say it as an level 3 inputs. Is it clear, everyone? So far, we have completed the standard on IFRS 13. Tell me if you have any queries, we can discuss that. Otherwise, we'll move on to ethics. Unquoted means basically, see, step 4 once again. See, understand. Okay, fine. I have got 2 queries, step 4 and level 1, level 2, level 3. Okay, I'll explain. Understand. In step 1, you identify, okay, this is the asset or a liability which I have to calculate the fair value. In step number 2, you identified, okay, this is the highest and the best use. In step number 3, you saw that, okay, I want to assess the highest and the best use in this market, either the principal market or the most advantageous market. Step number 4, you are applying the valuation techniques, might be using the market based approach, that is you will see what is the price of the similar asset, okay, what are the differences between them, and I will adjust that market price and I'll calculate the fair value of this one, okay, market price of this one. Or I will say what is the cost, what is the price if I purchase this asset now, if I purchase this asset now, what is the price of that, okay, basically the replacement cost method, okay. Third is income based, means from this asset, what is the income that I will generate in the future, let's calculate the present value of that, okay, apply valuation techniques and calculate fair value. So I will apply valuation techniques and calculate price, and from this price I will deduct transportation cost, which will give me fair value. Is this step number 4 clear, Ahana? Ahana or Ayush? Ayush, is step number 4 clear? Disclosure is not a part of step number 4. See, disclosure is a different. Disclosure is different. It's just a disclosure in the FS. It's not about any steps. See, these steps also not given in the standard. I have made these steps, okay, for your so that you understand the flow. Fourth point, okay. See, understand. Wherever you use the term fair value in the financial statements, okay, so you have to give a disclosure that the fair value are level 1 input, level 2 input or level 3 inputs. How have you derived the fair value? Level 1 input means you do have the quoted price of it. Like suppose investment in equity shares or mutual funds, right? All these things. You have the quoted price, listed price in the market, right? You can check it from there and just say it. Identical assets. Quoted price of identical assets. Quoted price of, see here, the quoted price of identical assets. But step level 2, I say quoted price of similar assets. There is a difference between identical and similar. Identical means same, exactly the same, right? Similar means not exactly the same, but somewhat the same. Crypto will be level 1. Yes, Arun. Crypto will be level 1. Okay. Level 3 is unobservable. There is neither the quoted price of this instrument or a similar instrument. Okay. There is no quoted price. There is no observable market inputs. Is it clear now? Like let's suppose financial asset. You have given a loan to someone. You recorded fair value, right? You recorded fair value, right? That fair value, can you see the fair value of that loan from the market? No. That is no market inputs are there, right? You are just computing on your own. You are unwinding the financial asset and recording finance income. The value that comes up is a fair value. Is also a fair value, right? Is also fair value. But again, that is derived. Not of this one. Investment property fair value level 2. Okay, guys. Now let's move on to topic number 4, ethics. Understand, guys, ACCA Code of Ethics says that all the professional accountants need to apply these 5 policies in their life, okay, in the professional life. Integrity means honesty. Objectivity means independence. And the threats to independence or threats to objectivity are self-interest, self-review, intimidation, and advocacy. Self-interest means when you have interest in the money, when you are interested in something. Let's suppose I'll give you an example. You have done wrong accounting treatment, or you have inflated the profit because your remuneration is dependent on profits. This is called self-interest threat. Self-review. You will review the work done by you. You will review the work done by you. Intimidation, under the pressure of someone. Under the pressure of someone. Advocacy, you are promoting something. You are promoting something. Okay? You are promoting something. Confidentiality, I believe all of you know. Okay? Professional behavior, it means it says that when you apply all the remaining 4, it means you are professionally behaving, you are behaving professionally. If you don't apply any of these 4, means honesty, integrity, objectivity, confidentiality and professional competence and due care, means you are not applying professional behavior. Professional behavior itself doesn't have any value, means professional behavior means applying integrity, objectivity, confidentiality and professional competence. Integrity, objectivity, confidentiality and professional competence. Professional competence means you do have the competence of the work that you are doing. You do have the competence for the work that you are doing. Okay. So this is the meaning of these 5. I believe you are clear on the ACCA Code of Ethics. What does the ACCA Code of Ethics says that? I believe you are clear. Now understand, practice. See guys, understand first before we start practicing a question, understand when a question on ethical issue comes up in the exam, before ethical issue it's an accounting issue. Before ethical issue it's an accounting issue. A doer and checker is accountant himself. Yes, Aditya. Yes, yes. Okay. You are yourself reviewing the work that you have done. Okay, means self-review threat. Okay, understand. Whenever an ethical issue comes in the exam, it will first be an accounting issue and then be an ethical issue. Okay. First, there is some mistake in the accounting that you have done. There is some mistake in the wrong accounting treatment that you have done intentionally. Wrong accounting treatment that you have done intentionally. Okay. That is called as an ethical issue now. Now let's read the question and try to understand it. Okay. We'll not wholly solve this question, but yes, we'll try to understand the approach. Understand guys. Calibra company operates in a property sector and has invested in new technology, okay, distributed ledgers, blockchain to trade and to support property transactions. The financial year end of Calibra is 31st December 2008. Okay, so I'll write here financial year ended 31st December X8. Okay, exhibit 1, apartment blocks. See here. Calibra company builds apartment block, which normally takes 2 years to complete from the date of signing the contract. Okay, the title and position and therefore control of the apartment blocks passes to the customer upon completion of the construction, meaning thereby this is the date when I receive the consideration and this is the date when I transfer the apartment blocks or apartment block, I write transfer apartment block to customer. Okay, this and the difference is 2 years. Difference is 2 years. Tell me which concept will apply here. Which concept will apply? Let me see who can answer it correctly. Which concept will apply? Which concept will apply, guys? Tell me, come on. Come on guys, fast. Which concept do you think will apply? Your SFC, Arun, wonderful answer Arun. Significant financing component. The gap is more than 12 months. Wonderful answer Nutan. Okay, now see here. Read. The price which is payable on completion is 9.55. So the question says that you can transfer control here and pay $9.55 million here. Okay. Now, if I am doing this transaction, any SFC applies. Can I say SFC apply if I am doing this transaction? Rather than pay, I write here receive. The customer pays, I will receive. I receive. Right? SFC doesn't apply. Okay, fine, understand. Alternatively, see what does it say? See here, read. Alternatively, customers can pay $8.5 million cash on the day when the contract is signed. It says now, see here. Alternatively, the customers can pay 8.5 million here as well. Okay, so consideration is received here, but the apartment block is transferred here. Now, in this SFC applies. In this SFC applies. Tell me yes or no. Tell me yes or no. Further. Let's read the question further. The chief accountant has calculated that this represents an appropriate borrowing rate of 6% for Calibra company. Okay, and assuming that this 6% is market rate. Okay, because it says that appropriate borrowing rate. Appropriate borrowing rate means what? Is a market rate. Appropriate borrowing rate means what? It is a market rate. Okay. Calibra company immediately recognizes 8.5 million as revenue if customers pay when they sign the contract. Is this statement correct? Is this statement correct? They recognize 8.5 million as revenue when they receive it. Tell me, is this statement correct? No, right? So what should be done? On this date, they should recognize bank account debit to contract liability. If I write C liability, they will say current liability. I write here contract fully. To contract liability 8.5. At the year end one, I will unwind and I will record what? Finance costs to contract liability. How much? At the rate of 9%. So can you please do that? 8.5 into 0.09. 8.5 into 0.09 is how much? 0.77. Not 0.9, it's 0.6, sorry. It's 0.6. 8.5 into 0.06 is 0.51. Is 0.51, and for year 2 it will become 8.5 plus 0.51 into 0.06 is 0.54, is 0.54, and the contract liability becomes what? 9.55, and here I will recognize a revenue, that is contract liability account debit to revenue to revenue, how much? 9.55. 9.55. This is how I have to do the accounting, right? This is how I have to do the accounting. Now understand. So we have done read exhibit 1. Let's come to exhibit 2. Let's come to exhibit 2. The chief accountant does not hold a permanent employment contract with Calibra. Okay, the chief accountant who has done this wrong accounting treatment, he doesn't hold a permanent employment with the company. Okay, he has applied for the position on a permanent basis, but is yet to be interviewed in the near future. Bodani company. Now see here. Bodani company is a customer of Calibra company. Bodani company is a customer of Calibra company. Now wanted to take the advantage of $8.5 million reduced price for an apartment block, but was having problems with the cash flow. Now see here, this is some issue coming up. Now. The chief accountant therefore allowed Bodani to pay 8.5 million and delay the payment until 1 month after the contract date. See, why was this 8.5 allowed? Because you have to pay it now. If you are delaying the payment, you have to pay the interest over that. At the rate of 6%. But chief accountant allowed this one. See why? See here. In return, Bodani company agreed to provide a good employment reference. Tell me, don't you think there is something? The Bodani company, the chief accountant. Don't you think there's integrity issues? right? The chief accountant is behaving in a is breaching or doing self interest threat. It's subject to self interest threat, independence and integrity, right? Plus integrity also lost, right? He is not doing honesty with the company, right? He is not doing honesty with the company, right? So these two threats, these two ethical threats. The chief accountant of Calibra company was afraid that he might lose Bologna as a customer and referee if he did not agree to delay in the payment. Exhibit 3. Calibra company has recently used distributed ledger technology, blockchain, to sell shares in property to investors. Okay, fine. Now these digitized transactions are only visible to the authorized parties. Okay, fine. The chief accountant publicly supports this technology and is to manage the new system. However, see this line, right? Understand properly. See this line. However, he has private concerns over the reliability of due diligence carried out on the sale of property, shares, and the potential violation of the local regulations. See, he publicly supports, but privately he even has his concerns. Publicly he supports, but privately he has concerns over it. The directors of Calibra want to increase the number of transactions. The directors of Calibra want to increase the number of transactions on a distributed ledger by offering digital shares in the whole of the entity's property portfolio. Although the chief accountant has a very basic knowledge of distributed ledgers, again see here, this is again a challenge. Although the chief accountant has very basic knowledge of distributed ledgers, he has assured the directors that he can facilitate this move, right? The project has been approved by the board despite the chief accountant's private reservations. The chief accountant has only recently qualified as an accountant and wishes to be employed with Calibra company on a permanent basis. Okay, so there are a lot of issues. Now let's read the requirement and understand how do we need to solve these questions. Okay, let's read the requirement. First, discuss how Calibra company should account for the sale of apartment block in accordance with IFRS 15. Tell me guys, are you clear on this part? Are you clear on this part? For IFRS 15 part, are you clear everyone? IFRS 15 part, all of you are clear? Tell me. The accounting for IFRS 15, all of you are clear? Now comes to borrowing costs. What does IAS 23 says? Tell me, what does IAS 23 says? What does IAS 23 on borrowing cost says? It says that capitalize interests costs on qualifying assets. And what are qualifying assets? The qualifying assets are assets which take substantial period of time to develop. Assets which require substantial period of time to develop. So don't you think this apartment block requires 2 years to develop? Is a qualifying asset? Tell me yes or no. Is a qualifying asset, right? So the interest cost which is incurred should be capitalized. So what should be done? The interest cost that is for year end 1 and for year end 2, that is 0.51 million and 0.54 million, right, should be capitalized to the cost. Should be capitalized to inventory. Why? Because apartment block is an inventory to me, right? Because it is held for sale, hence it is an inventory for me. Is it clear everyone? So this answers this query as well. Now, so requirement number A is clear, I believe. You can answer it for 5 marks. Requirement number 2, provide the accounting entries that would be required on the contractual sale of an apartment block on 1/2008 at the discounted amount over 2 years construction period. Journal entries I have already given you. See here, I have already given journal entries 1, 2, 3 and 4 journal entries, right? Already given journal entries. Journal entries are already given here. See, journal entry 1, 2, 3 and 4 journal entries you have to pass. It is already given. 9.55 will be ignored. Why will you ignore 9.55, Ahana? Why will you ignore 9.55? Cash will come into consideration. Ahana, cash is coming now at 8.5 million. Cash is coming now at 8.5 million. But you are transferring the goods after 2 years. But you are transferring the apartment block after 2 years. So what you will do? You will unwind this 8.5 million. First year 0.51, second year 8.54, and at the end of second year it will become 9.55 million. Which you will have to recognize as revenue. See this journal entry, please, everyone. Please see this journal entry, everyone. Yes, yes, Ayush. Wonderful answer. Wonderful answer. So this finance cost, see, ideally we transfer this finance cost to what? P&L. So what you have to write here? You have to write here inventory to finance cost. Transfer this finance cost to inventory 0.51 and 0.54. Wonderful answer, Ayush. Wonderful answer. Really impressed. But I believe we have solved this question in our live class also, right? So based on that also, no worries. But still, yes, if you remember that, it's a good part. Okay. Now understand. Understand. The third point. Discuss the way in which the chief accountant should have acted to ensure that he maintained high ethical standards in dealing with the issues described. Understand? For 10 marks. Understand, guys? Ethical issues. Tell me, what are the ethical issues that we identified? Tell me. I'm just identifying the ethical issues. Tell me. First, he had very basic knowledge. He had very basic knowledge of digitized ledger, right? Now, second part. See, when this here, second part is here. When the chief accountant having a very basic knowledge of distributed ledger, he assured the directors that he can facilitate this move, right? The second issue was facilitating the move. Despite having basic knowledge. Third part. Okay, third part. Publicly, or I can say publicly, he supported but had private reservations. See, tell me, what does it say? All these three things. First shows his integrity issues. Understand, guys? Let's not that way. First, we have to identify the issue, Aditya. First, we have to identify the issue, and then we have to recommend what he should do. Okay? This identifies that there is an integrity issue on his behalf. There is a professional competence issue on his behalf. Right? Now, how he should have behaved? Rather, he should not have accepted this work. He should not have accepted this work itself. Why? Because he don't know it. Even if he accepted it, see, what does it say? See here. Publicly support the technology and is to manage. However, he has private concerns over the reliability of due diligence carried out on the sale of property. He has concerns over the reliability of the due diligence report on the property. What he should have done? He should have engaged an expert. To do due diligence and get the comfort over that, and then support publicly, right? But what he did, he did not appoint an expert. Rather, he just tried to do everything himself, right? And assure the directors also that he will facilitate the move. But he is not having any knowledge, right? So again, this also shows that he is lacking, he lacks what? He lacks professional behavior as well. He lacks professional behavior as well. He lacks professional behavior as well. Right? Now understand further. Standard says that, see the question says that he is freshly qualified. He is recently qualified, right? Recently qualified. Recently qualified. Recently qualified are much more prone to you can say ethical issues, right? Because they don't have much experience, and they don't know what is correct and what is wrong. They don't know what is correct and what is wrong. Okay, say they are much more prone, right? And they want to grow in life, right? They want to grow, so they think, oh, this is the correct way, this might be the correct way to grow. Everyone does this way, so this might be the correct way. So he is much more prone to this one. Now third, you have to write here Bodoni case. You have to write here Bodoni case, right? And you have to link it with the self interest threat, and suggest that this should not be done. This should not be done, right? Either he should resign. Very good. Either he should resign, or do not accept the work. Do not accept the work. Do not accept the work. Right? Is it clear, everyone? So this is how you have to write, right? So I have just given here in the pointers. You have to definitely elaborate in the exam. Okay? I believe you have understood the question at least. Is it clear, everyone? Tell me. Is it clear, everyone? Tell me. So I think we'll keep it till here, guys. We'll keep it till here. So please revise all the chapters that we've discussed so far. Please revise all the chapters that we've discussed so far. Tomorrow will be our last day. We'll be discussing all the remaining chapters. For few chapters, like for example, government grants, borrowing cost, agriculture, that is you can say biological assets. Okay, all these chapters. What I will do, I will give you the link of my FR revision session in which you can go and do. Okay. And I'll give you the timing also. In the last class, I will announce everything. Okay, don't worry. But I will not be covering these chapters which I have already covered up in FR revision session, and they are exactly the same. Okay. So I will not be covering here again those chapters. I will be covering what is important for SBR. Okay. What I have already discussed in FR, I will not discuss it here. So that's all for the day, guys. Thank you. Bye bye. Bye bye, all of you.